Hamjambo wanafunzi. It is another day we are meeting for another class, and in our today's lesson I want us to do the third and the last illustration as far as the accounting statements for the non-profit making organization is concerned. Therefore, I want you to pay great attention as I'm going to demonstrate this illustration so that you can be able to understand any area maybe you have not understood. To serve that purpose is an illustration here which reads, the accountant of Mamba Sports Club has extracted the following information from the books of account for the year ended 31st March 2001. So we have the receipt and payment account, which is actually very, very common in this particular kind of questions. So on the receipt side, we normally start with the opening balance, opening cash balance for that matter, or the bank balance. And here on the payment side, we normally end with the closing bank balance or the cash balance. On the left-hand side, we normally have all the receipts for that particular financial year. And on the payment side, we normally have all the cash or checks payments for that particular financial year. Then we have been given this summary here for the balances as at 31st March 2000 and 31st March 2001. You will realize that 31st March 2000, this is the opening balances when the year was starting, and 31st March 2001, it is actually the closing balances or when the year was coming to an end. So, like for example, furniture and fittings, we started with a balance of 240,000, but at the end of the financial year, we had none. Equipment, we started with this, and at the end of the year, we did not have anything. Like subscription in Alliance, as we were starting the year, 300,000 were not paid. And as we were closing the year, 375,000 were not paid. The stock of beverages, this is the opening and this is the closing. The subscription in advance, as we were starting the year, 85,000 worth of subscription were already paid. And as we were closing the year, we had no subscription which were paid for the next financial year. And then we were given here some additional information that subscription in arrears are written off after 12 months. If they are not paid, they are actually not supposed to be considered as a subscription that will be received. They are actually written off. And depreciation is provided on a reducing balance as 10% and 20% per annum on furniture and fittings and equipment respectively. Then we have investments which had cost 500,000 were sold on 30th March 2001 for this amount. And you are told that no entries have been made in the books in this respect. You are supposed to prepare the income and expenditure account and the balance sheet. As I've always said, we have got some accounts that we are supposed to prepare which are actually not supposed to be indicated here. Like for example, it is obvious that you need to prepare the subscription account so that you can get the amount of money that you are supposed to take to the income and expenditure account. And we also need to prepare like if we are told that we have stock of beverages, then it simply means that this particular organization was conducting or was carrying out something like a bar or something like that, of which we are supposed to prepare the trading account. So you'll find that in the solution part, we have the bar trading so that we can ascertain the profit that normally comes or the profit that came out from the bar trading activities for that particular financial year. So the sales, which is actually supposed to be obtained from the receipt side of the receipt and payment account, was this less cost of sales, whereby we have the opening stock of beverages, we add the purchases of beverage. Remember, these purchases, you are going to get it on the payment side because when you purchase, you pay, and then you less the closing stock of beverages, which is actually under the balances, and therefore you get that this is the cost that we incurred to acquire those particular beverages that we sold. If it costed us this much and we sold the same this much, then we made a profit of this, which is supposed to be considered as an income when we proceed to the income and expenditure account. Then, if we can prepare the income and expenditure account, we find that the incomes, one of them is actually from the bar profit. Then we are supposed to prepare the subscription. And if you follow the procedure that I've strictly told you, you find that the subscription figure is supposed to come to this. Then this one, you now get it from the the receipt side of the receipt and payment account. You get the dinner dance income is supposed to be this much, and then the investment income is this, and then the profit on the sale of investment, you find that that investment was sold at a profit of that much. Then the expenditures, we get that we are supposed to do the salaries and wages, the repairs and maintenance, the office expenses, the printing and stationery, the dinner expenses, most of which you are supposed to pick them from the payment side of the receipt and payment, apart from the depreciation on equipment and furniture and fitting, which you are supposed to calculate. And then we have the subscription, which were written off because 12 months have already gone and they have not been received. And when they are actually written off, they form part of the expenditures for that particular club. And of importance also is to note the salaries and wages. The salaries and wages, we had the opening balance and the closing balances as indicated here. The salaries, we had the opening salaries accrued and the closing salaries accrued. How do we get now the figure for this particular financial year? The figure for this financial year, you get the salaries that were paid for that particular financial year as indicated on the payment side of the receipt and payment. This is actually supposed to be captured here. This is what we received, or sorry, what we paid this particular financial year. But not all this amount is for this particular financial year. What you normally do, this amount, you normally add what was accrued at the beginning. This much, you normally add what is accrued at the end because it is for that particular financial year. Then you less what is accrued at the beginning because it is for the previous year. So that amount, you add these and then you less these, you will find the figure for the salaries that were supposed to be paid this year. We are lessing this one because it is for the previous year, and we are adding this one because it is for this year, but it has not been paid. Anything for this year, we normally add. Anything that is not for this year, we normally deduct. And by deducting in accounting, we normally record on the other side if it is an account. When we proceed to the balance sheet, you'll find that we are supposed to follow the same procedure. The non-current assets, we have equipment and the furniture and fittings. But remember, when you are writing this figure, we must minus, first of all, the depreciation. So these figures are net book values. So it is actually the cost minus the depreciation, we get the net book value. So don't wonder, how did we arrive at this? It is the cost minus the depreciation that we have calculated for this financial year. Then we have investment, which is also an unfixed, we get it here. Then we add non-current assets with minus the current liabilities. The current assets minus current liabilities so that we can get the working capital. That working capital you add to this. So the current assets we had is the prescription in arrears and the cash at bank, whereas the current liabilities we had is subscription in advance and the salaries accrued. So if you add them, you get this. And then if you minus this, you get the working capital, which is this, which is supposed to be added to this to get actually the total net assets is this. And then the accumulated fund is this. You add the surplus, you get these figures are corresponding, and it gives you a confidence that you have done something that is correct. Thank you very much.